Welcome to the Deep Dive. We're here to give you the edge by breaking down the most critical financial commentary for experienced investors. Today, we're really digging into the Wells Fargo Q3 2025 earnings call. This wasn't just another update, was it? This felt like a potential turning point.
Absolutely. This report, which dropped on October 14th, it covers the first full quarter since the Fed lifted that huge $1.95 trillion asset cap back in June. So yeah, a lot of anticipation around this one. The operating reality has fundamentally shifted for them.
Okay, so our mission today is pretty clear then. We need to unpack these numbers, figure out the strategic shifts they're planning, now they have room to maneuver, and crucially, understand how they're justifying these, pretty aggressive new return targets that got the market so bullish.
Right, because the market reaction was strong, very strong. It suggests investors believe that shackles are really off this time. Let's jump straight into the results snapshot because honestly, it was a decisive beat pretty much across the board. Shows real momentum.
Okay, headlines first. Earnings per share. GAAP EPS hit $1.66. That smashed the consensus estimate, which is around $1.55. Net income landed at $5.59 billion. Pretty solid.
Yeah, definitely a strong beat there. And revenue wasn't far behind, came in at $21.44 billion. That also topped the estimates. They were looking for maybe $21.2 billion. And importantly, that's up 5% year over year. Shows the engine's picking up speed.
And I noticed the credit side looked better too. Provision for credit losses dropped quite a bit, down to $681 million from over $1 billion a year ago. That's a nice trend. Suggests less risk brewing underneath.
It certainly helps the narrative. But if you really want to pinpoint what got the stock moving immediately after the release, it was ROTCE, return on tangible common equity. They reported 15.2% for the quarter. That's already pretty decent.
Okay.
But then management didn't just pat themselves on the back. They immediately raised the medium-term target for ROTCE to get this 17 to 18%. That's a huge signal. It says, we're done fixing things. Now we're aiming high. That's the core story change.
Right, that 17 to 18% target.
Yeah.
That is ambitious. And it all hinges on that asset cap being gone, doesn't it?
Yeah.
Maybe just to remind us, for anyone who hasn't followed this saga closely, how big a deal is operating without that cap?
Oh, it's night and day. Imagine, trying to drive a performance car, but you can't push the accelerator past halfway. That cap physically stopped them growing the balance sheet beyond $1.95 trillion. They had to turn away good business. Now, the brake is off. First thing you see, assets blew past $2 trillion for the first time ever, and loan growth. Strongest quarter-over-quarter jump in period-end balances in 3 years. They can finally put capital to work.
And they seem very focused on where they're putting it domestically, right? They emphasize, over 95% of revenue comes from the U.S. consumers, companies based here. How does that focus help them hit that really high 17% ROTCE number?
Well, it's about leveraging what they already have. They've got this massive U.S. presence, top 3 in so many core areas. Instead of, expensive adventures overseas, they're doubling down here. Now they have the balance sheet capacity. They can push harder into high margin areas, particularly fee-generating businesses right in their home market. Scale plus focus.
Okay, let's talk specifics then. Where is that new capacity showing up? Investment banking seems like one area. Fees jumped 25% year over year to around $840 million. How'd they manage that? They mentioned gaining market share too.
Yeah, over 120 basis points of share gain in the U.S. since 2022. It looks like those investments in banking talent they made a few years back are finally paying off. The regulatory overhang probably kept some clients hesitant. Now that's clearing. And look at the deals. They advised on that huge Union Pacific acquisition of Norfolk Southern. $85 billion deal, biggest announced in 2025. That tells you something. Big corporate clients are clearly comfortable bringing them massive complex deals again. That's a seal of approval.
Yeah. Definitely a sign they're back in the major leagues. And the other area you mentioned was wealth management. See momentum there too. Net investment flows into their premier platform up, 47% in the first 9 months?
Exactly. That's sticky, high-margin business. It shows they're successfully getting deeper relationships with more affluent clients. That's a good long-term driver.
Okay. And even consumer lending is seeing some re-acceleration. New credit card accounts up 9% year to date.
Yes, but management was careful to manage expectations there. They pointed out that new card portfolios usually lose money for the first, say, 3 years. Only after that do they become really profitable. So this is about planting seeds for future growth, not an immediate boost to the bottom line next quarter. It's foundational.
Got it. Okay, let's shift to the sort of core profitability metrics. Net interest income, NII, that came in at $11.95 billion, up 2% year over year. Just to remind everyone, NII, that's basically the profit from lending money out versus what they pay on deposits.
Correct. The core spread business. However, the net interest margin, or NIM, actually dipped 7 basis points compared to the previous quarter.
Okay. Why was that?
Management had a very specific explanation. They said it was directly because they were putting the newly freed up balance sheet capacity to work in the markets business, essentially deploying liquidity into lower yielding trading assets. They were quite explicit, take out the market's impact, and M would have been flat quarter on quarter.
Okay, that explanation makes sense mechanically, but experienced investors always raise an eyebrow when margins dip, right? Is the market totally buying that it's just temporary deployment noise? Or could it hint at maybe deposit competition heating up or something else?
That's definitely the key question analysts are asking. The story holds for now. You get regulatory freedom. You have to put the cash somewhere. Trading assets are liquid, but lower margin. Fine. But Q4 will be critical. If NIM doesn't stabilize or start ticking up as loan growth continues, that temporary explanation starts to wear thin. For now, though, the overall NII dollar guidance seems okay. They reaffirmed the full year 2025 should be roughly in line with 2024, around $47.7 billion. And they actually guided Q4 NII up sequentially to between $12.4 and $12.5 billion. They expect loan growth and repricing to drive that.
Let's talk efficiency then, because you don't get from $15 billion in gross expense saves since 2019. That's a huge number. How did that actually help?
It was crucial. They essentially used those savings to pay for the massive investments needed in compliance, risk management, technology, all the stuff the regulators demanded to get that asset cap lifted in the first place. And here's the key part. They funded all that and still managed to cut overall non-interest expenses by $3.6 billion over the same period. Headcount's down significantly too, like 24% from the 2020 peak. So they cut fat while investing in the systems needed for the future.
But interestingly, they did raise the full year expense guidance slightly by $400 million, usually a negative sign, but what was behind it?
Yeah, context matters there. Two main things. First, higher severance costs than they expected, which actually means they're still cutting costs, just maybe faster or deeper in some areas. And second, higher revenue-related compensation, particularly in wealth and investment management. That's actually a good thing. It means they're paying out more because WIM is bringing in more revenue. You want to see that.
Okay, that makes sense. So finally, let's hit capital. This feels like the ultimate unlock here. CET1 ratio stood at 11%, and management announced a new lower target range, 10% to 10.5% medium term. That implies they feel they're holding way too much capital right now.
Precisely. They're sitting on a mountain of excess capital. Think about it. They returned $6.1 billion just in Q3 through buybacks. They also bumped the quarterly dividend up 12.5% to 45 cents a share. And even after doing all that, they still have over $30 billion in capital above the regulatory minimums. $30 billion. That's enormous firepower.
Wow. Okay, so wrapping up the analysis part. Governance seems clearer now, too. Charlie Scharf taking the chairman role solidifies things. But what about risks? We hear concerns about commercial real estate everywhere. Are we confident CRE losses are truly stabilizing like they said?
Management seem pretty confident. They've been building reserves for CRE for a while now. And generally, Wells's exposure is considered more diversified, maybe higher quality than some smaller banks. When they say losses are stabilizing within expectations, it means they aren't seeing blowups that would force huge new provisions next quarter. But, analysts will be watching reserve levels very closely going into 2026. That stability is absolutely necessary if they want to keep the focus on offense, not defense.
So looking ahead to Q4 into 2026, what's the single biggest factor that determines if they hit that ambitious 17-18% ROTCE target?
It really boils down to the pace and quality of capital deployment. Can they put that excess capital and new balance sheet capacity to work quickly in loans and other assets without sacrificing margins or taking on undue credit risk? That's the tightrope. Key things to watch. Continued IB momentum, NII trajectory, and clear progress on efficiency driving that ROTCE number up.
That focus on capital deployment tees up our final segment perfectly. All right, welcome to our This Is Not Financial Advice segment. Quick reminder, this is purely hypothetical for discussion and entertainment. Always do your own research.
Okay, so the idea here plays directly off that massive capital buffer we just talked about, that $30 billion plus sitting above regulatory minimums, and the fact they just lowered their target CET1 range down to 10.5%.
Right. Management guided Q4 buybacks basically flat with Q3, around $6.1 billion. That feels conservative. given the context.
Exactly. So the outrageous but plausible trade idea is this. What if the board decides to get way more aggressive? Forget $6 billion a quarter. What if they decide to deploy, say, $15 billion or even more of that excess capital via buybacks, like immediately over the next couple of quarters?
A massive accelerated buyback. Okay, why would they do that?
Because it's the fastest way to juice the EPS number and hit that 17-18% ROTCE target much sooner than the market expects. You dramatically reduce the share count, your earnings per share goes up mechanically. It's using capital efficiency as a shortcut to hitting the target. It sends a powerful message. We are serious about returns, the constraints are gone, and we're putting this capital to work for shareholders now.
So you're betting on management prioritizing hitting that ROTCE target super fast, using the buyback lever aggressively rather than a more gradual deployment.
Pretty much. Given they just escaped years of being capital constrained and the focus is now squarely on demonstrating higher returns, a big, bold move on buybacks seems plausible. Even if it's beyond current guidance, it would certainly accelerate the narrative shift.
Okay, so to quickly recap our deep dive today, Wells Fargo's Q3 showed a strong beat across the board. More importantly, it marked clear growth acceleration now that the asset cap is gone, backed by huge capital return potential, and that bold new 17-18% ROTCE target.
Yeah, the whole story has shifted. It's not if they can grow anymore. It's about how fast they can execute this new phase of capital optimization and growth.
And the final thought we'll leave you with is this. The challenge for Wells Fargo moving forward probably isn't finding the capital. They have tons of it. Is finding enough high-quality places to deploy that $30 billion buffer loans, investments without compromising the credit quality they worked hard to stabilize. Can they chase that 17% return aggressively and maintain discipline? That's the real test ahead. Thanks for joining us for this deep dive.